Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. No US cues. US markets were shut last night, but there is enough to sort of take it forward based off where we left off in a very interesting way on markets here. IT very much in focus once again. Lots more to discuss. I'm Prashant. With me, my colleagues Nigel and Dreema. Guys, good morning.
Hi, good morning. Well, Asia is in a complete holiday mode. So barring Japan, that's the Japanese market, Nikkei, the rest of the Asian markets are shut on account of Lunar New Year. So whether it's China, Taiwan, Korea, Singapore, all done, all out. So today we're on our own.
Well, that's right. And we're working hard, but participation was lower. Could be one of the reasons why yesterday we saw such bombastic gains. So let's see whether or not we can hold on to it, because participation was relatively lower. We'll get to that in just a bit.
Absolutely. And, let's just take it from the top then. I mean, not very much by way of fresh cues or anything of that sort. It's a holding pattern in that sense, right? So you got US markets which weren't trading for the President's Day holiday. And so no cues. I mean, futures were trading, but I think for half a day. So no big sort of, signal from there. Oil basically is up about 1.33% or so. And by the way, there are talks today, right, between US and Iran conducted naval drills in this region of the Strait of Hormuz, which is, of course, an important pass-through point for oil tankers in that region. And today is the sort of meeting between US and Iran. I mean, because it's been going on for so long, and what happens is sometimes because, there's some headline or the other, but there is no real breakthrough one way or the other, markets kind of get complacent. Well, this is going on at the back of the mind. But it's an important one. I mean, think about it. If there is a deal or there is no deal, and there's if it goes the other way, President Trump, of course, has been dangling both the carrot and the stick, right? With the stick, of course, is all the armada and the carriers and the aircraft carriers and all the fighter planes which he's positioned in the region around Iran. So, I mean, I think it's in that sense an important one, especially for oil prices, but I think for risk assets otherwise as well. Now, we got French President Macron, who's in India today, and he's going to be meeting Prime Minister Modi. And I think there's going to be, I guess, a fair bit of discussion around, deepening defense ties. And we'll sort of, keep a track of this. There is an event later today in Mumbai near the Gateway of India. And I think we'll hear from both leaders then. Now, I'll just quickly come to the levels because, I mean, beyond that, there's not very much. So yesterday, actually, the Nifty played out exactly in terms of the levels that we put out yesterday morning, right? What were the levels? 25,700 on the upside and 25,450 on the downside. So we bounced from the support of 25,450, notwithstanding, of course, the intraday breach of that level. We got below 25,400 intraday, but then, I mean, not on a closing basis, and that support in that sense, 25,450 remains. We got to the resistance of almost 25,700, I think 3 or 4 points short, and we kind of sort of, ended near those levels. So two numbers from here on the upside. I mean, the downside remains the 25,450 level. So we got to get past 25,750. And then the next stop, I mean, if we cross 25,750 is about 26,000. 26,015 is the precise level. I'm not going into the details here, but these are the two levels. If we fail here, which is 25,700, 750 in this zone, I mean, I think a retest of the 25,450 levels is possible once again. So in that sense, this is an important kind of area. And we'll see what happens. I mean, I think the cash market positioning, etc., is not all that encouraging. I mean, I think there was a glimmer of hope with foreigners starting to buy, but I think that started to turn negative once again already. GIFT Nifty on your screen gives you a quick sense of how we're likely to start, and we'll move it from there. So 100 points lower on the GIFT Nifty is the implied open. So we'll see in the next hour or so how that moves. Nigel has walked across to the wall with what the F&O positioning is looking like. Nigel, over to you.
Well, since the GIFT Nifty is down by close to under 100 points, the temptation yet again would be that maybe, in fact, this market is providing you a bit of a dip. Maybe a little bit of a wider dip is what the bulls will be looking forward to. And then they'll be looking to buy into that dip. At least that's what's been the trend. And they'll be hopeful that today more of the same does play out. In terms of institutional flows yesterday, the institutions were net buyers to the tune of more than 700 crores. That's the FI and the DI number put it together. The FIs, they were sellers, close to under 1,000 crores. But actually, the gross volumes from the FIs were 45% lower if you compare it with the February averages. So they were virtually absent in trade yesterday. They were not at full power in yesterday's trading session. So that could explain one of the reasons why we actually had a very, very good trading session, because the big seller was actually away. What did they do in the F&O market? Well, they went ahead and they added some long positions, close to around 2,000 contracts or thereabouts. The short position continues at around 80%. On stock futures, they added more longs than shorts, but that's a bit of an arbitrage play that takes place out there. Cash as well as stock futures is what you need to look at together. In terms of writing index options, well, in yesterday's trading session, those calls that were written earlier, they got wound out. You know, some of those call writers, they packed their bags. They said this market is moving in too much of momentum, so they wanted to move out. While on the put side, there was a good amount of writing. In an uptrending market, you want to see put writing. And because of the kind of put writing and call unwinding that you saw, the PCR had mentioned yesterday, it was at the lower end of the range. And that was one trigger to see that, you know, you do see a bit of a dip and then you see buying from lower levels, because that was at the extreme level. And normally at 0.6, 0.64 odd, you'd have seen a bit of a bounce. Now it's back to around 1.1. So one strike that was active, though, the 25,500 put, the premium, well, it crashed. It came down to around 30 rupees approximately. So there's aggressive writing that we're seeing at this particular strike, which brings us to the levels then. You know, if you look at a reference point, then yesterday's low becomes a reference point. Ballpark 25,350 or thereabouts. So you have the 200 DMA as well as yesterday's low. That's the important mark. You don't want that to breach on the downside. A little higher from there is the 20 DMA. But that's the important level that you don't want to breach. Until that holds out, you'll still be betting your chances that maybe, in fact, we see a bit of a bounce. But the tech index, you know, the good news yesterday was it made a higher low after a while. So yesterday's low, in fact, was higher than the previous day's low. So till that level holds out, you'll be hoping that you get a bit of a tactical bounce, because the tech index has got absolutely bombed out. So I'll keep an eye out on the tech index, because yesterday as well, the signs were encouraging. Towards the end of trade, actually, it recovered from the lows points of the day. Maybe, in fact, it got some bit of a relief rally that's due for the tech index. Let's see how that goes.
We'll find out today. Thank you very much, Nigel, for that. Let's invite Neeraj Seth, founder and chief investment officer at 3R Investment Management, on the show now. Neeraj, thank you very much for joining in. Limited global cues to discuss today. U.S. markets will open after an extended weekend, being shut yesterday for Presidential Day, and Asian markets was largely shut on account of Lunar New Year. So let's begin with the AI scare trade, because we've seen a massive sell-off. Like, global tech names have lost nearly $2 trillion in market capitalization in the month of February. In India, the Indian IT index is down 13% in the last fortnight. So at 3R Investment Management, what are you all doing? Do you own tech stocks? And what is the view now after the weakness?
So sure. First of all, we're more focused on credit across the region. But from a broader market perspective, I do want to highlight two aspects of AI which are actually playing out. And we have talked about it in the past. The first is the investors are questioning the AI capex and the potential return on investment on that capex. And you're seeing that playing through some of the direct players in the AI market. And the second is the second order effect of AI, specifically in software and services, where you're seeing a significant pressure on a number of software companies, not just in India, but across the globe, with what's happening in AI and how that evolves from the standpoint of the business model of the software businesses. And I don't think we have seen the end of it. So this is certainly something that will continue to keep some caution and pressure in the markets.
You mean in the US Mag 7 perhaps under a bit of fire going forward? That's what you mean, Neeraj?
I would say more differentiation. Even in the Mag 7, you don't see the performance to be actually similar across those 7 stocks, let aside the rest of 493 in the S&P 500. So the point is, you have seen the market have started to differentiate in terms of trying to predict who the winners and losers will be, or how to think about the return on investment from these large capex announcements, because not every announcement from a capex perspective is actually giving the boost to the stock, which was the case last year. So I think you will see more differentiation, and you will see obviously that, in a way, good thing that it will lead to broadening of the investors' portfolios with regards to diversification.
All right. Hi, good morning. Good to see you in. I wanted your view on the dollar index. You know, I was looking at a Bank of America survey that suggested that the shorts on the dollar index, that's the highest that we've seen in the last 14 years or so. Now, there's a lot of talk that maybe much of the easing is behind with regard to what the Fed has to do. And the optimism has cooled off with regard to the cuts that we'd like to see this year. In that sort of a backdrop, do you think the dollar index is nearing a bit of a base formation, or do you think it gets weakened further from here on?
So I look at it in two horizons, the near term and more medium to long term. In the near term, you're absolutely right. I think there is a consensus positioning building up. And with the CPI where it came, the markets are pricing more than 2.5 cuts now from the Fed, which I think is on the higher side. I don't expect another more than 1 to 2 cuts at most, which means in the near term, dollar can actually strengthen. But longer term, looking at the fundamentals, the balance of payment, and the expensive nature of where the dollar is, I still think in the next few years, dollar still has room to weaken further, which is good news for the emerging markets. But near term, I'll be cautious on being short dollar here.
You know, Neeraj, what I want to do is, and we'll cue this up, and I want to just play out these sound bites. And you might want to hear it. I just wanted your thoughts on this, right? You spoke about the dispersion in U.S. tech stocks and, you know, what you expect. I mean, the market's not responding to the news flow around the big U.S. tech names the same way it used to last year when these big investments, etc., were being announced. So we had, of course, we had this big AI summit in Delhi. But the CEO of the AI giant, Anthropic, is, of course, also in India to attend the summit. He was in Bangalore yesterday to announce the company's new offices. And this is what he had to say. It's basically saying that India is the second largest market for the company's popular chatbot, Claude. He says, well, the use of Claude in India is basically for highly technical purposes, which was interesting. I just want to play that out.
Anthropic's business, its run rate revenue within India has doubled over the last 4 months since I last visited. And Claude Code may have grown even faster. We're just going through the ability to kind of build software with AI and build as kind of developers on top of AI and build new applications. And I think again just the kind of efficiency of the market here, the energy of very large numbers of people wanting to find something and build something. I think that greatly exceeds what I've seen anywhere else. You shouldn't build for where the AI models are now. You should build for where they are in a year or two. If you're a large enterprise, if you're a big effort trying to build something, it's going to take a while to actually deploy and test things. So you should be imaginative about where the technology is going to go. Don't build for step 4 out of a 10-step workflow. Try and do the whole workflow, even if the AI model isn't quite capable of it yet. The companies that have understood that, the kind of users that have understood that, I think have gotten much further ahead than others, and they kind of see the future because they're able to use models in ways that correspond to a product that we haven't released yet.
Okay, and now, of course, Dario is going to be in Delhi on 19th. There is the big panel in which there's Sam Altman and Anthropic and Microsoft and others, etc. Neeraj, any thoughts? Indian IT services. I don't know if you have any feedback at all.
So two points on that. The first, I would say, we are now moving from the very basic AI application hardware infrastructure story to the beneficiary story. And it's going to move from the point solution, which is the productivity enhancement at individual level, to a system redesign, is what you heard in the points he made. And the second is, I am actually quite optimistic in the long term in terms of India's ability to pivot and position itself as one of the service providers with AI for system redesign, not point solution, which brings me back to 1990s when the whole IT revolution started. So I think there is a potential for the IT services companies, specifically the ones who can pivot, to position more alongside AI, helping the underlying businesses to benefit on the productivity side. We haven't seen that as yet, and hence the market is nervous. But I'm very certain on one thing: not all software or services companies are going to go away in the next 10 years. It's going to be a more who is able to pivot and actually provide the differentiation in terms of the services. And I think it's going to happen. I'm quite optimistic in the medium term on some of the better quality IT services firms in India.
Yeah. Absolutely. Thank you very much. And good chat there, Dheeraj. Thanks for your time. Let me just quickly run you through the interactions which are lined up here over the next 2.5 hours or so. 8:35, we've got the management of Galaxy Surfactants to discuss the company's December quarter earnings. 9 o'clock, we have Ragvesh of JM Financial to put the spotlight in capital markets. 9:20, Gautam Shah of Goldilocks Research. He's a market master. 9:35, the management of Happiest Minds is going to be with us to talk about the F527 outlook and, of course, the state of AI. The management of Tenneco India will be speaking with us at 9:45 on their third quarter earnings. Towards the end of the program, Lata in conversation with Siva Ramakrishnan of Gokuldas Exports on life after the US, India-US deal, the framework deal, and, of course, what's happened with the EU as well. Stay tuned.
Welcome back. Let's talk about stocks now. This is CNBC TV 18's list of top stocks for the day. And this time it's Ria compiling that list for us. Ria.
Well, good morning. Let's start off with Cotton Shipyard first. They have emerged as the L1 bidder for the construction of 5 next-gen survey vessels for the Indian Navy. The total order value is rupees 5,000 crores, and the order book of the company as of the end of Q1 of FY26 stood at roughly 21,100 crores. Tex Macro Rail will also be in focus today on the back of an order win. They have received an order worth roughly 210 crores from the Mumbai Railway Vikas Corporation. JSW Infra will be holding a board meeting on the 20th of February to consider a fundraise. MSC Development has received a RERA approval for its first project in Alibag. The estimated GDV is at rupees 400 crores for this one, and the launch is planned in Q4 itself. Lupin has signed a license and supply agreement with Spectus to commercialize a novel antidepressant called Tesla Flex in Canada. And lastly, TVS Supply Chain will also remain in focus today. They have signed an MOU with an Italy-based company called ALA to enter India's $28 billion aerospace and defense supply chain market.
Okay, thank you very much for that. And keep your eye on the Infosys AI Investor Day. That begins at 11 o'clock, and the first track is going to be Nandan Nilekhani, who's going to talk about why AI transition is different. And then it's going to be followed by the CEO, Salil Parekh, who will talk about the AI services opportunity with CNBC TV 18. We'll keep getting you more on that, but that starts at 11, and I think it ends at about 4:30. But let's talk about the macros now. India's trade deficit hit a 3-month high, and the big culprit, besides falling exports to the US, was the very high gold imports. Gold imports rose almost 3x compared to the prior year. Lata joins in with the details. Lata.
Yes, it's a 3-month high trade deficit at almost $35 billion. I mean, we have done worse in October when, again, gold was the culprit. People buying gold for Diwali. And this time it's gold again. Let me just give you the overall data. January imports were up 20% YOY, about $71 billion, a large part contributed by gold. And Jan exports were almost flat year on year, up about 0.5% to $36.5 billion. Like I told you, the culprit was gold. Gold imports were $12 billion. I don't ever remember reporting such a large number. This is 3x what it was, in fact, 3.5x what it was a year ago, January, at $2.7 billion, and also 3x compared to this December. So month ago, year ago, both it is about 2 to 3x. Higher gold imports were partly because of the very high ETF demand. You remember when the Amphi data came, we were all preening that gold ETFs are almost equal to the flows into equity mutual funds. It was about 24,000 crores, a record. And what we learn is ETFs have to be backed a bit by physical gold as well. And that may have contributed to this extraordinarily high gold import. Just to speak about the other exports, what did well for India in exports was actually engineering exports, up about 10%. And what was perhaps, I hope it is not the start of a worry, electronics exports, always a winner for us, were flat. Just about $4 billion as it was a year ago. I hope this is a one-off trend. Textiles fell, and that's not surprising, but unsurprisingly, marine exports have done well. As we know, they have been able to diversify out of the US. Overall, April-Jan exports have been up only 2.2%, whereas April-Jan imports have been up 7.2%. To speak about US itself, month on month, the US exports fell by 22% in Jan. But if you look at April-Jan again, we are still running at a positive 6%.
All right, Ladha, thank you very much for that. I mean, absolutely right. I mean, for all the ETFs, I mean, the financial instruments, I mean, rules say that you have to have that, it's got to be backed by physical stuff here in India, and I think that's contributed to that big jump in the import number there. Well, let's talk about, I'll stick with commodities for a bit longer. Manisha is here with a roundup of the action. And of course, I think oil is in focus, but what else? Manisha, morning.
Well, absolutely. Thank you for that, Prashant. Oil is what I'll start with as well, because a second round of talks between US and Iran starts today. Iran on Monday, in the meanwhile, has launched a maritime drill at Strait of Hormuz. This comes in on the back of US deploying a second aircraft in the region. So even as we're looking at talks on the ground, both the countries continue to increase their war machinery there. And US-led negotiations between Russia and Ukraine also start today, so there are two events to watch out for, only for crude in that sense. In the meanwhile, you have IEA and OPEC both talking about a surplus situation in 2026. OPEC also says that they might be resuming supply hikes for the month of April. Well, that decision is something that the OPEC will take in the first week of March. So plenty happening in case of crude oil prices there, and we're looking at steady prices ahead of both of those very important talks coming in. The other metals have gone in for a bit of a profit-taking. Gold has declined for a second straight day. We are trading below $5,000 an ounce onto this one. And silver fell 2% overnight. Well, there is a situation of weak liquidity as many markets in Asia are shut, and that perhaps seems to be bothering. In any case, you also have Fed meeting minutes, US GDP, US inflation data, all of that number also coming in this week. So ahead of that, it's a bit of a decline that we are seeing in this space. And not just gold and silver. Copper fell 1% overnight. Nickel is trading at a one-month lows. We've seen profit-taking in zinc and aluminum as well. So metals as a segment seems to be going in for some more profit-taking.
Got it. Okay, all right, Manisha. Thanks a lot for that. Well, let's hop across to Sudarshan. Wakes up early, goes through a lot of brokerage notes and gives us an insight on a few of them. Morning, sir. Hope you're feeling good.
Good morning, Nigel. So I have few stocks. First one is L&T CLSA maintains outperform call with a target price of 4,842 rupees per share. And this note comes after the company has executed the agreement to sell Nabha Power to Torrent Power. And because of this, CLSA believes that company will get rupees 26 per share, and it may announce special interim dividend because company remains focused on achieving ROE of 18% this fiscal. And because of this exit from Nabha Power, this will add to the ROE of the company. Next one is Fortis Healthcare. Over the weekend, company had announced earnings, and yesterday it held investor call, and that one commentary looked largely positive, and most of the brokers remained positive in the stock as well. Citi maintains buy call with a target price of 1,120 rupees per share. It mentions few catalysts. First, existing hospitals showing strong traction. Brownfield expansion at high occupancy facilities set to improve the margin for the company, and newly acquired facilities are performing well as well. And parent company IHH remain open to further equity infusion. Last one is Tata Motors Commercial Vehicles. HSBC maintains buy call with a target price of 534 rupees per share. It believes that M&HCV demand remains strong, and it's being led by capacity additions by small fleet operators, replacement demand from large transporters, and upside risks. First one, introduction of new engines. Second, Iveco stability, and third one is recovery if it sees in LCV. And valuations as compared to Ashok Leyland and all the PE players remain at discount for Tata Motors Commercial Vehicle. That's the reason HSBC is positive.
Yeah, no, absolutely. So thank you very much for that, and we'll sort of get some more views on this one as we go along. Well, let's take a quick commercial break here. Mayuresh Joshi of Mark Smith India is going to be with us for some fundamental stock conversation. We also have the management of Galaxy Surfactants to discuss their numbers and the outlook going forward. So K. Natarajan joins us for that. Stay tuned.
Well, let's welcome the first management on the show, Galaxy Surfactants. That's in focus on the back of their Q3 numbers. To discuss the past quarter, What's the way ahead? We're joined by Mr. K. Natharajan, the Managing Director and CEO at Galaxy Surfactants. Good morning, Mr. Natharajan. Always good to speak to you. Hope you're doing well this morning. Well, the past quarter's numbers we have, a bit of a soft quarter with regard to margins. But let's look ahead. What's the guidance for FY27? Considering there could be some respite in the industry, India and US have got into that trade deal. So give me two numbers. Volume growth that you'll end this year with, and on that base, what kind of growth will you be looking at? And the EBITDA per ton as well. What could be the broad range? Please go ahead.
So this year, I think we have met multiple headwinds and we have managed to put a good set of numbers. The flat 9 months volume growth rate, and also, but then yes, we've been able to show growth in a EBITDA per metric ton. 20,000 and all this quarter. Now, for 27, I would probably look at ending the year with a slight volume plus. Okay, it all depends on how things goes in this quarter. And EBITDA per metric ton, I'll stick to my range of 19,000 to 21,000. We would have done a good job if we are closer to the higher end. But yes, we need to see as to how the balance portion of this quarter goes.
Just to confirm, sir, volume growth for this year will be, and next year? I didn't get that number.
Volume here for this year, I said, will end flat. Okay. For next year, I would like to wait probably till May when the India numbers pick up, because it's expected as the commentary of all our customers in India that they are seeing some green shoots because of the GST rationalization. But we need to wait at least till May to be able to have a clear picture on what the volume growth will be for FY26-27.
Okay. Sorry, sir, we still couldn't quite catch the volume growth guidance for FY26. What is it going to be?
I said, see, our 9 months has been flat.
Okay.
And then I said we would be pretty happy if we are able to report overall slight volume plus growth for the 12 months. But yes, we're keeping our fingers crossed.
Okay. So volume growth flat, maybe just a minor single-digit kind of a growth for the full year. But in that, your specialty care volumes have done particularly well. That's seen a growth of 35%. Was that a one-off, or can specialty, care volumes continue to see this kind of growth rates?
No, it is a combination of certain projects in pipeline that matured and we were able to start the business in Q3. But also, as our response to the US tariffs, we had initiated certain aggressive market placement of volume. So that also aided. So I would expect it to be a good growth, but it's not that we'll keep continuing to 35% growth. But what is important is that with the US tariffs getting taken care of, we do see all our projects in pipeline that got suspended in our North America market getting revived. And that would help us getting into the next financial year.
Mr. Natharajan, morning. Just one quick point. This is the specialty stuff you sell into Europe mostly, right?
No, it's rest of the world. Europe and North America and Latin America are the big markets.
I see. So it's kind of evenly spread out. It's not just, it's not skewed.
It's not just, no, not exactly, because Europe, we have been having challenges since the time, it has been battling its own problems. Right. So we do have a lot of projects that are in the pipeline, but some of them are not getting progress the way we want it to be because of the challenges that some of our customers there in Europe are having. So we need to pivot across. We need to pivot across North America, Latin America, and Europe. North America, we had a headwind in terms of the tariff. That having gotten taken care, we do hope things will look better in the coming quarters.
For the US, that for the specialty chemicals you produce, the tariffs are dropping, are going down, because you'll have to go line item. When the agreement comes out, right? But you think for you, tariffs are going down?
No. First of all, there are two things. It has been announced that the 50 goes to 18. The 50 has suddenly gone back to 25 because the Russia crude penalty has been removed. Okay, so 50 comes to 25. The question that we need to wait for when the details emerge is whether the 25 remains 25, 25 comes to 18. But that's too early to say. But 50 to 25 itself is a significant relief.
I see.
So how big is the US market for you as a percentage of your revenues right now?
So there are two aspects. One is US market. We look at what our subsidiary Trike does that, okay, which is a huge business within the US. So that obviously is not as much impacted by the tariffs. But then what we do from India and Egypt put together, we're talking about 10 to 12%. Okay, and we do see there's some products that really got impacted in a very huge manner, which we do from India. That would start getting better due to the tariff getting reduced.
Okay. So your volumes in AMET, that's Africa, Middle East and Turkey, saw a double-digit decline. A, what led to that? And two, has it bottomed out? Can we expect some improvement?
I'd say that the struggle in AMET continues because two of our biggest markets, Egypt and Turkey, are battling significant currency depreciation as a fallout of the huge inflation that they have. Now, that has impacted consumption and also the significant amount of competitive intensity with certain players in the end market who also are backward integrated. Now, I'd say that this seems to have bottomed out. Okay, we do see certain better numbers emerging, but we'll have to probably wait for 2 more quarters to see how it sustains.
Okay, just one more question. I think you spoke about in one of your major tier 1 client, there was a volume loss due to some change in formulation. Has that been resolved, or have you received commitment from the large client, or will it continue to drag?
No, the reformulation obviously has happened in terms of the way that the oleochemical prices and the crude petroleum derivative prices have significantly expanded in terms of the pricing. So that is something that continues to be a challenge because fatty alcohol prices don't seem to be relenting. It continues to be at a high level. So we do see in this, the customer does tell us that they're looking at if it softens, we'll see probably whether there is some reformulation happening to our advantage. But as of now, we're preparing to see how we are able to participate in the reformulation by coming up with our own line for the alternate surfactant.
No, absolutely. Thank you very much. Good luck as you sort of execute.
Thank you.
I appreciate it. Mayuresh Joshi is with us, Director Research of Mark Smith India. Mayuresh, good morning. Good to have you with us here. Thanks for joining us. Just a quick word, Mayuresh, on this, on of course, what was the big story yesterday with regards to the RBI circular on prop trading and capital market exposure with regards to banks. The one big hit, of course, was BSE, which came off the lows, but, it's clear, and I think the HDFC Securities CEO put it plainly. He said, you look at what the STT hike is telling you, you look at what the RBI is doing, you look at what SEBI is saying. I mean, it's all kind of synchronized towards, bringing down speculative activity, essentially in the F&O side. So just your thoughts here, Mayuresh, and what would you do with the stock?
Morning, Prashant. No, I think, as you rightly pointed out, I think the regulatory moves are pretty clear. The STT hike, what RBI has done yesterday with the final conclusions that it has come to, it is pretty obvious that speculation and speculative trading is something that both the regulator and the RBI probably wants to put a cap on. And therefore, are there more regulations coming in terms of SEBI norms? Is it something that we should look out for? But with the existing norms, it's pretty clear that speculative activities are definitely under the radar. Having said that, I think asset managers, Prashant, within the capital market theme is always one space where we believe at Markets with India that the kind of consistency that one really expects over the next few years, both in terms of equity and debt flows happening through SIPs or direct investments, and wealth management as a theme. The number of individuals who will probably need wealth management solutions or the households are actually expected to double over the next 5 years, which means you will need specialized professionals to probably manage and diversify your entire wealth management perspective as an asset class. And therefore, I think asset managers, HDFC Asset Management, is something where the rating rankings look absolutely fine as we speak. And therefore, within the space of capital markets, I think these players are where the rating rankings look very, very strong at this.
Hi, Mayuresh. Good morning. Good to see you, Ben. What about Ola Electric? There's another downgrade that's coming. Nimesh just sent us a note, I think, from Citi. Yesterday, there was a Kotak note as well. The story is going horribly wrong. What's your view on the stock? I recall just after listing, the stock went dancing away to around 140 rupees. Then it came down and then it had a big relief rally actually with a lot of funds tanking up. Now I believe some of them have sold out. The stock is up 30 rupees. What's your take?
Morning, Nigel. I think we've always stayed away from this stock, even from the listing day itself. I think our perspective was that the bigger players in the same space have done the right things. Obviously, they are diversifying as we speak, and they've got better capabilities in terms of both sales, service, and distribution as well. And that is where I think the strategic advantages lie with the bigger players, even when it comes to the entire EV ecosystem. For a large part of the upcoming EV ecosystem or the startup market, I think both the aspects in terms of dealership and distribution and service is something where they might require specific amount of resources and capital to be pumped in, which the bigger players have at their disposal as we speak. And therefore, our take was always that the bigger players are always better positioned as time elapses. And a lot of the launches that we've now probably seen from the bigger players in the ecosystem are happening at the right price points. They are happening with the right perspective in place as well. And with fewer complaints, so as to speak, with a straight comparison to what Ola has been facing on all these aspects put together. So I think the bigger players in the ecosystem might continue.
The deal which got concluded overnight, Torrent Power, has announced the acquisition of Nabha Power from L&T. And L&T, according to CLSA, is going to cash in 26 rupees per share, and therefore they're looking at a special dividend that's coming in from L&T. And for Torrent Power as well, the acquisition makes sense. Valuation appear to be reasonable. Have you all analyzed this deal?
Well, didn't get a chance, Rima, honestly, to probably look at that. But I think from a strategic perspective, I think L&T is one stock that we continue holding in our global portfolios. I think when you talk about capex and when you talk about the flag bearer of capex in India, I think L&T probably comes to mind. And obviously, I think the kind of divestments that L&T has been doing in its non-core assets or businesses where they at least feel that they're no longer interested in carrying out on a very positional or strategic kind of scale. I think they're probably doing the right thing. Having said that, I think the expectations in terms of the overall order book, in terms of the overall working capital, in terms of expectations of ROEs, I think that should have a steady state improvement. So in my own sense, didn't have a chance to look at the deal, but L&T still remains one of our top holdings as far as leadership stocks are concerned in our global book.
All right. Myresh, I know you follow healthy living, so I don't think you're a smoker. Tennis as well as something that's normally, one of your favorite sports. But what about ITC? The stock has seen a sharp pullback. Now, over the last few days, you've heard of price hikes. I don't know the exact quantum, but they're trying to evolve the business model as well with regard to introducing different sizes of cigarettes as well. And I believe there are some price hikes that have come about. The stock has got slammed. Biggest underperformer post that duty hike. Your view on the stock at current reckoning, is bulk of the bad news in the price? Would you look at it?
A large part of it is, yes, in the price, Nigel. But again, I think in terms of pure demand and elasticity, I think the kind of numbers that the cigarette business will throw out in terms of an absolute revenue or an absolute EBITDA might not have a significant dent with the price hikes they've probably taken. My only concern with ITC is the announcement that they've done 3-4 quarters back in terms of foraying into different products. And you've seen this in the past when they got into the other FMCG business. It took quite a time for that business to properly scale up. And a lot of capital investments, which probably kept both ROEs and ROCs on a consolidated basis under check. And that is where the concern lies, in my opinion, at least, with the kind of capital investments that can go in terms of developing new products, exploring new markets, and ensuring that they become 100 crore plus products in terms of market size over the next few quarters. ROEs and ROCs will probably remain far more stable or under the radar as we speak. And therefore, I think a sideways time correction is what we believe ITC might go through. Within the FMCG pack, our take again is that Nestle India probably has been a standout as far as numbers were concerned for the quarter.
Okay, all right. What we're going to do is take a quick commercial break here. So stay tuned. We're back with some volume buzzers from yesterday. Sudarshan and Mitesh also, of course, joining in with some technical trading ideas. So coming up in just a bit. Okay, welcome back. Sud is back with us with the big movers from yesterday and, stuff which moved around with heavy volumes, notable volumes. Sud, over to you.
So amid the recovery that we had seen in the market yesterday, we had few stocks that saw huge trade with healthy volumes. First one on the list is Precision Wires. That company had announced earnings over the weekend. Those earnings looked very strong. And on the back of that, we saw a huge move in the stock. Stock is currently at a 52-week high. Yesterday, it had moved 14% higher. And volume yesterday was of 2 crore shares versus 10-day average of just 6 lakh. And if you talk about the earnings, profit is doubled in Q3 and EBITDA was up almost 80% YOY. Next one is Indus Towers, which has been saying buying by promoter, that is Bharti Airtel, since the start of this month. And this stock too is at a 52-week high. And delivery percentage was above 50% for 9th straight session, and Bharti Airtel, which is the promoter, has bought 45 lakh shares since February 5. Additional 12 lakh shares were bought on 11th, and that was reported to exchanges yesterday. Last one is the auto ancillary player. Normally we don't talk about this stock, but off the late, this stock too has been buzzing. That is RACL Gear Tech. Yesterday that stock was up 50% and volume was at 10 lakh versus 10-day average of just around 23,000. This too had announced earnings over the weekend and revenue was up 21% and margin too, company has managed to hold above the level of 21%.
Yeah, absolutely. Thanks very much, Sud, for that. I mean, that was a big one, right? And on very large volumes as well. Figure in the top 15 odd volume-led gainers on the NSE yesterday. Mayuresh, of course, is with us with what he'd want you to do as we sort of, look ahead. The Infosys Investor Day, Mayuresh, is today, right, in the morning. And it's what a time to do it, right? Because everybody's talking about what all these models will do to Indian IT companies, analysts and writers, and but except the IT companies themselves. So I guess this is today we will hear from the IT company, a top IT company themselves. What's your sense? I mean, what would you like to hear, really?
Prashant, I think two things. One, I think the AI competition, if you want to call it that way, I think is serious, and it is something which IT companies need to take cognizance of. But it's not just some kind of inorganic acquisitions that is probably going to aid or help or abet them in terms of this journey, but some serious introspection in terms of how these companies are probably going to adapt to this entire AI ecosystem as we speak. And therefore, I think gearing up to the challenges faced by the AI substack, as we see it, I think there has to be some serious roadmap over the next few years in terms of how IT companies are probably planning this. Second, I think the entire model itself will change because in the past, what we've seen in terms of the entire outsourcing, outprocessing model that IT companies have traditionally been doing, if they probably have some element of a capex done, both in terms of upskilling of their employees or having a dedicated capex in terms of creating these units, that might take some sheen away in terms of both the core margins itself, as well as some elements of buybacks and dividends that these companies have to announce. So I think how these companies are going to probably navigate through these challenging times, which is a need of the hour over the next few quarters, as I say, is something that the markets will like to hear, because other investments done by major platform and product companies in the US are massive as we speak.
Yeah, absolutely. We'll be interested to hear from them today. And we'll sort of course, report on it as details start to emerge. Thank you very much, Mayuresh, for joining us here. Now, the Indian trade negotiators will be visiting the US next week to finalize the agreement for the first tranche of the trade deal, that is India-US. The team will pursue a reduction of tariffs from 25 to 18%. Remember, 50 to 25 and now 25 to 18. Abhimanyu is here with some details that he picked up. Abhimanyu, over to you.
India's chief negotiator Darpan Jain is expected to visit the United States next week to finalize the legal agreement for the first tranche of a BTA. Now, India is expecting US tariffs to drop to 18% by as early as this week itself. However, if that does not take place, there is a likelihood that the Indian visiting negotiating team may take up the issue in person with the American officials. Both the sides are looking to sign a legal agreement by March 2026, though the Commerce Ministry indicated that a deadline cannot be ascribed to the same. On the import of pulses and varieties of cotton from the United States, more clarity is awaited on market access in the legal agreement. So it remains to be seen what would be the exact details which are going to be mentioned in the legal agreement, which both the sides are looking to sign by the March of this year. Now, digital trade barriers also are something which both the sides are going to decide, even as there has been an indication from government sources that digital trade barriers will not be a part of the first tranche of the BTA. As far as India's import diversification from the United States is concerned, the US is being looked at as a potential source for a diversification of imports in not just energy, but even for parts of data centers, as well as for several precious metals, in which India is looking to increase its overall imports from the United States as part of increase in bilateral trade. As far as cotton is concerned, India is already importing US cotton worth $250 million, and since the demand for cotton is expected to rise within India by virtue of an increased market access within the American market and also in several other FTA partner countries, there have been indications as per government sources that more imports of cotton may be undertaken to ensure that there is no shortfall of cotton in production within India.
Thank you. Very important details there. For now, we'll slip into a break. On the other side, we'll come back with the pre-opening rates. We'll also be joined by Raghvesh of JM Financial to put the spotlight on the capital market stocks. Welcome back. Yesterday, market staged a strong rebound. We saw buying through the day and ultimately ended at the day's high around the 25,682. Today is also the Nifty weekly expiry. Where are we headed from here? Let's get in our experts, Sudarshan Zakhani and Mitesh Thakkar, on the show now. Gentlemen, good morning. Gap down opening is what the Gift Nifty is suggesting. Does that throw up a buying opportunity? What is the call for the day? Sudarshan, go first.
Yeah, good morning. Unfortunately, no, the gap down doesn't suggest a buy on dips opportunity. Best case scenario for the Nifty is that the Nifty starts consolidating around these levels, say somewhere around 25,500, up and down a little. And that makes it choppy. Choppy markets are not good for trading. This is very rare. The Nifty has been an avoid for the last 3-4 days now, which is very unusual. But I don't think we should be looking at the Nifty at all. We will see choppy action, and we have to wait patiently for a consolidation to complete and show us direction. So avoid.
Okay, all right, got that. Avoid the Nifty is the call from Sudarshan. Mitesh, what do you think?
Yeah. See, on the index, yesterday's bounce back was slightly more than what I had anticipated, but I also mentioned that till we get past 25,750 levels, we will not be sure of this being a convincing turnaround. So I think today that might not happen, and we will again fall below the intraday and the daily moving averages, which means that the upside level of 25,700, 750 remains, and the overall structure is slightly on the weaker side. So I would believe that there could be a retest of 25,450, and maybe even lower levels could be tested. But this will hold as long as we don't get past 25,750 on the upside. So yes, on the index, from a day's perspective or a 2-day perspective, no trade available with the gap down. But yeah, we'll trade with stock-specific prices.
Okay, gentlemen, morning. Mitesh, what would those stocks be? What would you want to trade?
So I have a mix of buys and sells today. Morning, Prashant. One of the buys is Exide. It's been consolidating in a very tight range of about 340, 142 to about 330, 332. A breakout above 343 should suggest a target of 352. So buy about 343, take a 4.5, 5-point kind of a stop loss at 339, and a target of 352 on the upside. Then a sell on Angel 1 with a stop just about 2600 for targets of 2505. Sell on Hero Motors. Hero Motors in the short term could decline to about 5400, 5390 levels. So sell with a stop at 5550. And Fortis looks like, the stock is turning around after a good correction. So this could be a trade on the long side with a stop at 896 for a target of 955.
Sorry, Mitesh, missed it on Angel 1. Is it a buy or a sell?
Angel 1 is a sell call.
Angel 1 is a sell call. Okay. Sudarshan, what would your calls be?
Before my calls, yesterday Prashant was asking if there is an ETF for the IT index. There is. It's a very popular one. It's called ITBEES, ITBEES. It's a high volume ETF. And I would suggest investors who are looking to buy the sharp correction in IT can consider start nibbling into it and buying small lots. It's a separate part. I have Bank of Baroda as a buy with a stop under 285. Cummins Industries as a buy with a stop under 44.45. Two shorts, Colgate stop above 2160 and BPCL stop above 380. So it's a mix.
Yeah, no, thank you for that, Sudarshan, and the IT. I think on it's liquid, and I think that is important in that sense. So widely sort of traded and used in that sense. Thank you, gentlemen, for that. So that's Sudarshan and Mitesh with the trading ideas. We'll go back to them for their 9-10 calls in a bit from now. But let's get in, Ragvesh now, who's with us. He's of course with JM Financial. And he tracks insurance and capital markets at JM. Ragvesh, good morning. Good to have you with us here. Thank you for joining us. We can calculate the impact in terms of P&L because of the prop trading thing, which has happened, the RBI circular. There is understanding that is a segment which is hit. HDFC Securities yesterday morning, same time, told us about 40% of volumes is from prop, F&O. And they expect about a 15-20% hit to F&O volume starting the 1st of April. So two questions. One is earnings impact and consequently stock implications in your coverage universe. But second, something again which the HDFC spokesperson said that it seems like everyone is very focused, all RBI and government, etc., to bring down volumes, speculative activity in that sense. And that is kind of hard to model in right now. We only know what we know. But there may be other stuff coming. I don't know. So how does one account for that?
Yeah. Good morning, Prashant. First of all, thanks for having me on the show. So yes, rightly put, hard to model it out. What will be the impact on the volumes? My sense is on the retail volumes per se. If we look at a retail investor, the risk reward, what a retail investor can gain from F&O still remains significantly higher than a cash transaction. For the prop volumes, yes, we do expect some impact coming in. Like your guy mentioned, a 15% kind of impact. We'll have to essentially wait for it to play out. But when I look at the companies I cover, say an Angel One or a Grow, significantly dependent on F&O volumes, around 50% plus of the total revenue for both of these guys comes from F&O. But on the retail, I'm not expecting a very significant impact, at least on the retail side where these are largely focused. In my coverage, say a Nuvama Wealth is largely dealing with the segment which is more HNI prop oriented. But over there, the total portion of the revenue which comes from this is not more than 10 to 15%. So again, I don't see a major impact on a name like Nuvama Wealth. Now, broadly, if we look at it on a structural basis, financialization is here to stay. While SEBI has over time, raised concerns on retail investors losing money in F&O, they will find newer avenues to make money and play the India growth story. In fact, for the names Angel One and especially Nuvama Wealth, I would see the current disturbance, the current weakness in stock prices as a good buying opportunity. Another name I cover, 361. It's relatively less exposed to F&O. Hence, the impact has also been limited on the stock price. But I would definitely consider buying Nuvama at these levels.
Yeah, you would buy Nuvama at current levels, right? So that's a one actionable kind of sort of item from all of this at this stage.
Yes, even Angel One at current valuations looks good to me.
Yeah.
Of course, there will be the odd action from the RBI, from SEBI, from the government of India, but at valuations of around 15x on FY28 earnings, I think these are pretty well factored in.
Yeah. Ragvesh, the Jain and the Jump and the Citadels of the world, they use their own capital, right? They don't use banks, obviously, and not Indian banks. Am I correct?
Yes, and that is my sense as well. I have not looked at their balance sheet, but it's pretty obvious they will not be using Indian banks.
Indian banks, got that. What about something like a BSE and, of course, the yet unlisted NSE? What's the impact on exchanges because of this?
So I don't track the exchanges space, so I'll not be a good person to give my views there.
I see. We had someone yesterday who said that, and this is a theme, right? Financialization and more savings into markets, financial products, basically, and the intermediaries are all these brokers and everybody else in the value chain. Is that a theme? Is that thesis unbroken, or you think perhaps you got to account for some of this there? I mean, if you got a long enough timeline, long enough investment horizon, Ragvesh.
See, the key is which are the products which have a longer runway for growth. Like what we are incrementally seeing is, say a couple of years back, people would be fixated on a lot of sectoral funds. Say a specific stock idea which can say double in a year. Now what we are seeing when the markets have been choppy, if we look at the mutual fund inflows, they are incrementally going more towards the flexi caps, more towards the hybrid categories. So people are essentially entrusting their fund managers to make that call, make the stock call, make the capital allocation call for them. So I would look at a space where you are not just focused on, say, stock ideas, but where you are offering a holistic wealth management solution to the client. Hence, structurally, I'm very positive on the wealth management space, 361, Nuvama, AMCs which have established and are getting significant inflows. Like if I look at the AMC space, say 5-6 years back, the inflows as a percentage of the opening AUM would be somewhere around 7-8%. Now that number has increased to, it was 17% in FY25. Even this year, we are expecting it to be somewhere around 12-13%. Now, 12% in inflows. Say structurally, the equity markets give you 12% odd returns. So we are looking at an AUM growth in equity plus hybrid of around 24%. With some pressure on pricing, 20% is my top line growth. Expenses typically don't grow beyond 15%. So there would be short-term disturbances, but we are looking at a structural story of around 20% earnings compounding in names which are well established, have a decent track record of 20, 25, 30 years of performance. So broadly, I would be looking at more of the AUM-linked businesses which are offering a holistic solutions. Like I mentioned, 361 Nuvama. In the AMC space, names like HDFC, AMC, and Nippon Life.
Okay, got that. Thank you very much. Very useful, Ragvesh, and just in terms of how to think about some of these areas and pockets, because of news flow, which we got, of course, over the weekend, and beyond this as well. Well, I think it's now 9:10, so let's get Sudarshan and Mitesh back with us. Sudarshan, what do you have?
It's Bank of Baroda. Buy Bank of Baroda with a stop under 285. Okay,
BOB and Mitesh?
I'll go with the buy on Exide if it starts getting past those levels of 343.
All right, let's talk about IT, because everyone is trying to figure out where IT sector is headed next after the sharp 13-14% correction that we've seen just in the last 2 weeks. The question is there more pain ahead, or is value finally emerging? So this is some brokerage views that we got earlier today. Now, UBS believes the sell-off may be a near-term overreaction, but they do warn that questions around long-term growth cannot be ignored. They're saying for Indian IT companies to defend growth will require IT companies to move beyond just pricing and delivery, and they have to move up the value chain. So now it's over to the IT companies to adapt. On valuations, they say the large caps are trading at 16, 21 times earnings, which is below historical averages. And even the valuations imply terminal free cash flow growth of just 4 to 6%. That said, so valuations are attractive, but they're still saying that there is a question mark on what the long-term growth will be. For UBS, in the near term, they see a gradually improving environment supported by macro tailwinds and rising AI readiness spending. Nomura, on the other hand, calls the current correction a front-loading of pain, where markets are pricing in the death of the old business models even before AI-led gains emerge. Valuations are now below the long-term average, and they believe the current dividend yield, free cash flow, could create a near-term floor. They're giving you 3 scenarios. Scenario number 1 is a very low growth environment where IT companies grow by 2 to 3%, maybe even no growth or negative. At that point, PE valuation multiples slip to 10 to 12x, which means massive derating if the IT companies grow at 2 to 3% or below. The second scenario is if growth gets back to the long-term averages, which is high single digits, 7, 8%. In that case, valuations stabilize near the early 20s. The bull case is that, these Indian IT companies become AI orchestrators, completely AI ready. And in that case, we're talking about, some PE re-rating. So I think the nutshell is from both UBS and Nomura is valuations are below the long-term average. But what we don't know right now is where the growth will settle for the Indian IT companies. If growth trends down due to disruption, there could be pain ahead. But if growth recovers as Indian IT companies pivot, reset, then perhaps there is value at this level. So that's the view coming through on IT now.
It's very interesting, Reema, and we'll track how they open up once again. Yesterday, of course, about 1/3% higher on the Nifty IT index after the recovery that we saw on Friday from the lows. 2 minutes out, IPCA is what we want to focus on once again. Vinny is here with details. Vinny, morning.
Hi, good morning. So IPCA Labs, in terms of the con call highlights, numbers were okay in line with expectations. But interesting highlights came in the con call, and post that we've seen some upgrades coming in terms of the target price. Firstly, Nuvama is highlighting they're maintaining the buy rating, they've increased the target price, they're delivering strong margins. And they've delivered the strongest margins in almost 4 years. The branded business, that has contributed around 50% during Q3, which is doing well for the company. And that has increased in terms of contribution on a year-on-year basis as well as on a quarter-on-quarter basis. Now, obviously, India business continues to do well. Africa side, LATAM side, they've seen strong performance coming in on that front as well, which is supporting the growth for the company. Axis Capital also, they said that the business mix is something that improved the profitability for the company. And in terms of the important highlight, Unichem performance, which is there, that is expected to start normalizing in the next 2-3 quarters. And post that, we'll start seeing an improvement in terms of margins over there as well. They anticipate the EBITDA margins for that to come up to 15%, post that as well. So now, companies also evaluating some GLP-1 in-licensing opportunities, and that is why Axis Capital also has raised their EPS target by 1 and 3%. Axis Capital has raised the target price from 1,480 to 1,610, and Nuvama also has increased the target price to 1,750.
All right. You got market open coming up anytime now. There we go. And how are we starting? It's absolutely flat, slightly sideways, about 0.25% down, I think. Yeah, 26,615. So it's what, about a 70-80 odd point cut. The Nifty Bank is down about 1/3% right now, 60,760. The mid cap index is down 100, 59,615. Small cap index is coming up on your screen, and there as well. It's flattish, right? 15 odd points higher, 17,065 at this point. So it's not a bad looking screen at all. And 25,600 is where we are at about 1/3% down to begin this particular trading session. Heat map should come up in terms of how the 50 stocks are opening up. And then we will look at some individual movers. Asian Paints and BEL on one end, there's Infosys in the green as well. And on the other end, you've got Hindalco, Eternal, Shriram Finance, and a few others. But it's all, 12 odd names which are higher than everything else, which is starting in the red right now. Garima.
Well, the Nifty defense sector is the one which is holding up in the green. That's up nearly 1% today. Remember, geopolitics takes center stage as French President Macron will meet Prime Minister Modi, and where they will discuss defense, technology partnerships. So defense is in the limelight. IT names, as Prashant pointed out, are rebounding a bit. Again, the rebound is meager. The Nifty IT index is up 1/3 of a percentage point, but Infosys is holding up well, 1% up. HCL Tech seeing buying emerging. TCS is now back in the green. So BEL, some IT names Asian Paints is moving up well. That's got a gain of nearly 1%. But on the way down, you've got softness coming through in Reliance Industries. That's the heavyweight dragging. Metal names are subdued. Hindalco, Tata Steel under pressure. Hindalco is the top Nifty loser with a cut of 2%. Eternal is sliding, and now it's dipped below the 50-day moving average. Eternal currently at 281, 50-day moving average 283, so sliding below that level. M&M, Trend, Nestle, Shriram Finance, Grasim, Cipla. These are some stocks that you can spot on the way down. But it's a quietish opening. I know we've got a negative bias going. We're down close to about 0.3%, but volumes could be on the lighter side today.
Well, that's right, Rima. You mentioned earlier today, right? There are quite a few markets that were shut, and that's why, in fact, participation could be lower. And we saw that even in yesterday's trading session. Let's run you through a few stocks, though, that are bucking the trend. Kochi Shipyard, they've bagged a naval vessel contract worth 5,000 crores. The street likes it. Up and about in today's trading session. So big move out there. TVS Supply Chain, they are partnered with Italy's Ala Group for aerospace and defense. They're saying it's a big opportunity out there. For now, the street is enthused. That stock is flying away in trade. Texmaco Rail, they're bagged an order worth around 220 crores from the Mumbai Rail Vikas Corp. That stock as well, moving on rather high volumes on the upside. You have a couple of more stocks that are actually moving around. JSW Infra, this will be an interesting one. They have a board meet in the next couple of days. I think there was a bit of a buzz with regard to this. And they're going to be considering a fundraise. So JSW Infra as well is a stock in focus. And Stylim, we saw a large trade that took place earlier today. I think it's part of the broader deal. So Stylim is a stock that comes up for you in this trade. Net, we're a little bit lower. Par for the course, one would say. A good rally yesterday. Participation relatively low. Expiry today. That's what will add some spice towards the end of the trading session.
Absolutely. And it's what is slightly sideways right now, right? 80-odd points, 25,600. And you've got the Nifty Bank, which is sideways and slightly lower as well. Gautam Shah is with us. He's founder, Goldilocks Global Research. Gautam, good morning. Great to have you back on the program. Thanks very much. So looks like we're once again in the range, a little higher, a little lower, but eventually by the end of it, point to point, not very much to show for it. What's the top-down view, and then we'll get into it in terms of sectors, and IT is something we want to talk about. But the top-down Nifty, Bank Nifty view.
Good morning, Prashant. Yes, it's been 5 months that the markets have really gone nowhere. You know, it's been oscillating between greed and fear. Every time we move to levels of 26,000 and beyond, there is a feeling that we will do well and we will break out and we move in sync with the rest of the world, but it just doesn't happen. And every time there has been a dip, including the budget day, I think the markets have found support at lower levels. So I think it's just been oscillating in a very large range, and in the global context, this is really underperformance, because while in absolute terms, the markets would not have seen much weakness, but in relative terms, India continues to underperform the rest of the world, whether it's Asia, whether it's US or large parts of Europe. There is still nothing very exciting on the charts, because the problem is there is no leadership. You know, the technology index is in a big mess. Reliance refuses to contribute, and there is too much responsibility on the banking sector. And many of the other sectors like capital goods or auto or pharma, you know, haven't gone anywhere in the recent past. So in this environment, and with the Trump card already being used by the bulls, you know, some time back, it's very difficult to believe that the Nifty can break out immediately. So I think we will meander in a range for some more time. 25,450, I think, is the immediate support. If you break that on a closing basis, there could be more near-term weakness, possibly towards the budget day low. And only if we get past levels of 26,000 are we going to see strength. So in a nutshell, I think it's going to still be a range-bound market with a very volatile and possibly a bearish bias. However, this is still a very theme-specific and stock-specific market. And I do believe for the rest of the year, the broader markets will do much better than the large caps in the top 100.
Good. Gautam, you've at Goldilocks Research, you've consistently maintained a bearish view on the IT sector. And you've tweeted that that stance is now validated. But after this kind of a fall, technically, where is the Nifty IT index or individual stocks headed? What is the call now?
Yes, Seema, I think 6 or 8 months back, we saw the first glimpses on the charts where we believed that AI is here to disrupt a lot of what is happening in the country with companies and that seems to have been validated by the markets with the kind of fall the IT index has seen. It amazes me that an index which was at 40,000 comes down to 30,000 in a matter of 8 days. So there is just no time to react. There is no time to think. Markets do what they have to, and they're doing it very quickly. I do believe that the IT space is in a multi-quarter kind of an underperformance, and this is going to continue. We are still not recommending any sort of bottom fishing. 31,000 is an important support for that index because it's been the low for the last couple of years. And if that were to break, I think you're going to see much more downside. So I still don't see any positives for that index. For that matter, if you look at global tech, it continues to do quite well, whether it's some of the tech stocks in China, in US, and for that matter, even in Europe. But Indian tech, for some reason, hasn't fared. And I think this underperformance is going to continue.
All right. Hi, Gautam. Good to see you again. You believe the underperformance could continue on that one. What about gold? Has it paused for breath? Or do you think, it's looking a little bit weakish? It could pull back a little bit more?
I think it's paused. I think it did what it had to. We witnessed a beautiful blowout rally at the highs, and thereafter we saw a very large correction for silver. Gold saw a more normal correction. I think the bullish momentum has been broken. It was a very, very overdone. Retail had got into it, not just local but global retail, and I think it was being extrapolated as the next big thing. And when you come to that stage, you just know that all the positives are in the price. So I think gold and silver will get into a volatile phase of consolidation. They will not go up much. I think levels of 46, 4700 will now act as a base, and levels of 51, 5200 will act as a ceiling. And silver also, I think it's just going to stay in that band of 65 to 95. So I don't see any big opportunity for gold and silver, but there is a huge opportunity in global equities as a basket, because there you are seeing massive trends in the last 6 months.
Yeah, no, I mean, the biggest gainer right now, just to go back and turn our attention to what's happening, apart from what we mentioned, is Cochin Shipyard. Cochin Shipyard is up 6% on very outsized volumes right now. So number one volume-led gainer on the NSE, that's Cochin. There is K Fintech, which is having another good day. K Fintech went up sharply. So from 950 to 1050 between yesterday and today. Texmaco Rail is another one, right? I mean, I think 8.5% is coming up with large volumes for this point in the day. Praj Industries is another one, about 7.5% gains. Go Digit Insurance is up about 4%. You got Shakti Pumps, which has been absolutely pummeled. It's at about 576. It's up about 2% with volumes, but that's it. I mean, go down the list, volumes start to thin out very quickly if I look at the gainers kind of screen. Vedanta is down 2%, and Vedanta, with that 2% cut, is also the number one volume-led loser on the index. Eternal is down about 2.25%. There is Hindalco, Hindustan Copper. Ola is down another 3% right now at about 27, 28 odd rupees. So just sort of, with 5 minutes into market opening, taking a look at where there is where this is showing. Gautam, the other, I mean, at least in terms of news flow, etc., right, which I think many have pointed out, a secular kind of theme, etc., is defense. I mean, you can make all kinds of fundamental arguments for it. But stocks got re-rated in a big way because of all the ordering over the last 3 years. Now, I think next 2-3 years, it's all about execution because the orders are in. And stocks have reflected that. Well, how do you think about playing this one? Or you think they're also the big opportunities, maybe some of the global players? And just talk to us about that, Gautam.
Well, Prashant, I think markets discount orders and not execution. I think markets are way ahead and these days too smart, and probably most of the positive and the news flow around the orders are already priced in. Many of these stocks are trading at very, very expensive valuations. So honestly, I don't see an opportunity in defense or railway, and I've maintained that stance for almost 6 months. Barring a couple of stocks that have done well, like a BEL, I really don't see many other opportunities. But the real opportunity in my book is the entire PSU space. And I think I've highlighted this a couple of times in our earlier interaction as well. The market loves value. The market is looking at value. And you've seen what stocks like SBI and some of the other PSU names have done well. So whether it's oil PSU, metals PSU, coal PSU, infra PSUs, I think this entire basket looks very interesting for me. And I think while the Nifty goes through this very challenging phase of underperformance, I think money is going to be made in PSU, and smart money and domestic liquidity that seems to be coming in on a daily basis is going to hide in that pocket. It's probably one of the safer pockets in the market. So in my book, it's just financials, PSU and metals. I think these are the three themes that we like, and we feel that one should only commit on the long side in these three sectors.
PSUs, metals, and which one, Gautam?
Financials, metals, and PSU.
Financials, metals, and PSUs. PSUs and metals, of course. I mean, PSUs especially big outperformance last year, and I think this is PSU financials, ex-financials, everything, right? The CPSE's basket.
Absolutely. I think the entire space, I see a very large move. I wouldn't be surprised if the PSU index appreciates by about 25% from here in an environment where Nifty is going to find to even deliver 5 to 7%. So I think that's huge underperformance if you can align yourself and if our view turns out to be true.
And the best way to capture that is what, CPSE ETF or something, or some stocks out of that basket. And anything you like, you want to point out, Gautam?
Well, passively, I think CPSE ETF or similar ETFs are obviously the best opportunity because I am told that the PSU index has about 20 stocks. It's not a very large set of stocks that you're really betting on. And if you can just focus on those 20, and if you can get a quality outperformance out of, say, 7 or 8 out of them, and many of these stocks are at a dividend yield of 6, 7, 8%, and now capital appreciation seems to be kicking in. And we've seen a lot of initiatives by the government from the PSU space, and the charts are beautifully aligned, and you're also seeing a lot of relative strength, versus all other sectors in the market. So it looks like a happy place to be in.
All right, Gautam, let's talk about a couple of stocks. Then SBI. If I remember correctly, we had a chat earlier, and you said that this is one of your top bets. You can correct me on that one, actually. But if ballpark the stock was around 1,000, 1,020 or thereabouts, it's given a quick fire of 15%. Good for more, or has it run its course?
I made this comment, I think it was on your channel sometime back, that I prefer a 10-11 PE banking company than a 60 PE paint company. And I think that's really been validated by the market in the last 6 months. And honestly, you didn't need to be really smart or use rocket science tools to understand this beautiful trend that has played out. SBI has been a favorite, no recommendation. And I think we continue to like it as a story because I think it is still very, very cheap on an overall basis. I speak as a fundamental analyst and also as a technical analyst because both of it is aligned quite well. If you look at the PSU index, the PSU banking index, if I'm not wrong, a few days back, it was at lifetime highs. And I think there is clearly more to come. So be where there is relative strength. You don't need to buy something cheap because cheap is getting cheaper and cheaper and cheaper in today's market. And that's a dangerous place to be in.
Any view on the big boys? HDFC Bank showing signs of coming back to life, gone through a bit of a time-wise correction. The other boy is Reliance Industries. I'm just asking you because these are like indices by themselves, with 8 to 10% weightage on the index. So view on particularly HDFC Bank as well as Reliance Industries.
Unfortunately, there's nothing positive coming out of both the charts. They have been consolidating and they've been trying to come out of a range for almost 5 months now. And I guess the FI selling that has been happening, consistently will obviously, attract money into some of these stocks in the top 10 or 15 stocks. So in that sense, I think the Nifty it's difficult for the Nifty to really break out on the upside. And because of domestic liquidity and the global market strength, the markets might find it difficult to break down as well. So I think the best thing that can happen for Indian markets is they stay in a range. It become a stock pickers market, be in the right pockets, and that's where value will be created.
Okay, got it. Thanks a lot, Gautam, for joining in. So the broad point is the headline index stays in a bit of a range. The broader markets could outperform. There'll be opportunities coming in, particularly from PSUs as well as the metal index. And in fact, select stocks look good. And SBI was a stock I think we spoke about last time around. That's had a beautiful, beautiful move, that we've seen. So, that's about Gautam's view. But let's talk about Ola. Can't keep the stock out of action. Sudarshan has joined in to tell us about how the numbers are looking and what our brokerage is making as well. Sud.
So as we were talking about yesterday, that the company had reported Q3 FY26 earnings, and those earnings were very weak, and stock was under pressure. Yesterday also it had fallen almost 7%. Today also stock opened with a cut of almost 3%. And in the last 2 months, say in 2026, so far the stock is down more than 20%. It's at a record low. Now, if you talk about yesterday's volume was 8.5 crore versus 10-day average of around 4 crore. And brokerage downgrades continue. Today, Citi has come out with a note, has downgraded the stock to sell from buy, and target is cut to 27 rupees from 55 rupees per share. Lowest target price on the street is rupees 20 per share. So further downtick we can see in the stock price, and considering the weakness that we have been seeing in the earnings for the last few quarters. What is Citi saying? EV penetration in Indian two-wheeler sector has been sluggish. Company has lost market share. As of January 2026, company's market share was less than 6% versus 25% that company held in the early 2025, say in January of 2025. Citi is saying management's efforts to improve product and service quality could take some time to fructify, but healthy gross margin trends and better operating leverage could boost EBITDA. But negative cash flow, that is, as of 9-month FY26, free cash flow was in negative of 1,530 crore rupees. That could result in the concerns related to the balance sheet. It has cut estimates and target EV to sales multiple to 3.5 times versus 4.5 times. Now, at the start of FY26, after basically Q1 earnings, company had given the guidance for FY26. Now, let's see where exactly company stands after 9-month FY26. So, on the auto business EBITDA margin, company had said that in FY26, that margin may increase and may be above 5%. As of 9-month FY26, that is at minus 6.4%. On gross margin, the range was 35 to 40% for FY26. Currently, it stands at 29.6%. Volume target was in the range of 3.25 to 3.75 lakh units. So far in FY26, they have done just 1.5 lakh units. Revenue target was in the range of 4,200 to 4,700 crore. And as of 9-month FY26, or say FY26 so far, they have done just rupees 2,000 crore. So it's reflecting the weakness that we have been seeing in the earnings, and that's reflecting in the stock price.
Thank you very much. Very helpful. And some details starting to come through, right, with regards to Infosys and the Analyst Day. So Infosys has announced a collaboration with Anthropic to unlock AI value across complex and regulated industries. So that's the news which is coming through. Look at the stock. It's up about 2.5%. And I'll just quickly look at where I think... it's climbed now. I mean, I think as the news came through, 9:28 or so. Yeah, I mean, this move is basically not even last 5 minutes. Last 4-5 minutes or so. The stock's climbed steeply. You're not able to see that. But yeah, it's all since that news broke, I guess. Almost 3% higher on Infosys at this stage. So 1404, 1405 on Infi. And this collaboration with Anthropic to unlock AI value across complex and regulated industries. So more on this one in terms of what this would mean, etc. I guess at the Investor Analyst Day and beyond that as well.
Just one quick word on the index. The tech index on Friday made a panic low of around 31,350. It's up 2,000 points since then because of the oversold levels, because of some kind of glimmer of good news, case in point being the announcement that's on the screen. And also the index is heavily shorted. It fell one way down. So let's see whether or not it can sustain this. But otherwise, the last few days for those that were gutsy enough to buy it on Friday, it's up 2,000 points.
There's, of course, all kinds of players making the market, Nigel. But on Friday, as you said, on Monday as well, there were some insurance companies who were buyers. And I think yesterday as well, Monday as well, there were some insurance companies. But of course, there would be other players who perhaps could have. And of course, a covering element as well. So 2.75% on that Anthropic news and Infosys. Now, the India AI Impact Summit 2026 is underway in Delhi. And Ashmit joins in with more on, what we should expect. Ashmit, good morning.
Hi, good morning, Prashant. I'm joining to you from what is the nerve center of the AI Impact Summit. That's the CNBC-TV18 Edge studio from right here at the Expo. We have been covering, we saw day one as well. It was a little chaotic, but that was what the minister, in fact the secretary government officials have been calling was a roaring beginning. What we saw was basically a whole host of leaders descending upon the national capital. Again, the big numbers, what they're telling us, they're expecting over 2.5 lakh attendees. Big faces expected, the likes of Sam Altman, Jensen Huang unfortunately could not make it. Sundar Pichai would be here, Demis Hassabis, Dario Amodai. They will be all here as a part of the conversations at the AI Impact Summit. What's also important to watch out for is the nature of what those conversations are. One aspect that, in fact, we have been talking about in great detail has been what this dynamic is between AI, between automation, and what that means for white-collar jobs, what that means for the IT sector. That's clearly going to be front and center. Another aspect that will be front and center will be the nature of investments that we can expect. This is not an investment summit, so that is not the focus, but nonetheless, what officials tell us is that there's likely to be announcements with respect to investment commitments going forward. Mind you, the likes of Amazon, Google, Microsoft have already committed to over $70 billion for the AI ecosystem here in the country. Another aspect that will be up for conversations, and this will be a big step up as far as India is concerned, will be launching of India's own sovereign models. Now, that has been a key focus area for the India AI mission, the 10,000 crore rupee outlay that we've seen over the last year or so. What's important is that there will be Sarvam, the Indian AI company, will be releasing its 100 billion plus parameter sovereign Indian LLM. That is not the only one. Companies like Gnani AI, which have been in fact picked under the India AI mission, will also be releasing their sovereign models. And this, importantly, was a key thrust area for the government. In an era of tech sovereignty, there was a big thrust by the Indian government on ensuring that India has its own language models. India has its own architecture where it can compete with the best in the world. And to that end, we will be seeing those announcements as well. As to the other themes, we've visited pavilions. The likes of Geo Pavilion is here. We went to the OpenAI Pavilion. We went to the Microsoft Pavilion as well. A whole host of robotics are on display. We'll, of course, be getting you a sneak peek as to what this marriage between AI and robotics look like. That will be a key area that makes some very interesting content in terms of what the future holds with respect to what some of these companies are manifesting, are displaying here at the AI Impact Summit. So clearly, a whole lot of content, a whole lot of conversations to unpack here from the AI Impact Summit. And of course, we'll be getting you all of that and a lot more from the CNBC-TV18 Edge AI studio, right at the heart, at the nerve center of the AI Impact Summit.
Indeed, conversations there will continue. Thank you very much, Ashmit, for getting us a ground report for now. In fact, it's a cue to invite an IT company. Joseph Anantaraju, co-chairman, CEO of Happiest Minds Technologies, now joining in. Thank you very much for joining in. Joseph, I think the question that people are asking now with the rise of agentic AI is that, one, are clients pausing large transformation deals because they're reassessing the strategy? And two, there is a change in the way clients are negotiating pricing. They're asking for more in terms of efficiency and productivity. If you could share what is happening with Happiest Minds and your clients on these two fronts.
Sure, Prima. Let me first take on the agentic AI. If you look at agentic AI, I think you can apply it in 2-3 ways, right? If you're an end customer. The first is you look at your own workflows and how do you really embed, an agentic AI approach into your workflows. And that needs a little bit of re-architecture, re-looking at how your applications are designed and how the data is collected. And so we're seeing some of the customers going down this path. The second one is looking at your internal operations and seeing how is there some way to optimize customer service or help desk and other things using an agentic AI approach. And and the third one is using it in SDLC. And here we are seeing two different trends, right? If you look at more of greenfield development or add-on development, it takes a little bit more, I would say, effort to really use this approach. But if you're looking at modernization or addressing tech debt, where there's a code base already that that your AI can understand and then apply, there we are seeing customers beginning to look at the opportunities that this presents. So I think agentic AI actually is making customers take a step back and look at, can we do things differently? Can we do things more? And can we do new things? And that's what we are seeing, And when you come to pricing, if you look at, AI and productivity tools, if you look at it from a broad construct of three models, right, that the Indian IT industry uses. One is more of people-based, whether it's external engineering or staffing or whatever you call it. Second is fixed price, and third is outcome-based, which is still, on the lower side. But I think we need to move in that direction. I'll come to it in a minute. But if you look at it from a people-based, there's a rate that you get, and there's no impact from a pricing perspective. What you can do is go back to customers and say that, hey, we have these AI trained engineers, whether it's Cursor or Agentic AI or Copilot approach, and look at getting a little bit of premium, and we're beginning to see that. Second is on fixed
Joseph,
price.
if I can, sorry, there's a lot to take in. If you can break it up a little bit. Good morning, and thanks for joining us.
Yeah.
I just wanted to, and we'll come to some of what you're saying, and very useful. This specific point, just news breaking that Infosys is tying up with Anthropic. You must have seen just 15 minutes back, the news broke. Now, what would it really mean? Is it an official acknowledgement of what is already happening across companies? Because the release itself says that they already, the founder of Anthropic is in the press release saying Infosys is already using this. So this is a formalization of that tie-up, and would this also, what would this entail? Some revenue. Are there any revenue implications in terms of revenue sharing of some sort, or this is a cost out to Anthropic for them to use? But that was already happening, right? Because it's Infosys would be paying Anthropic to use Claude and other things. So what? And will we see more of this, more of these announcements by IT companies quickly?
Yes, I would think so, because Anthropic is just one of the options that you have, Claude. And in a short while, you'll see an announcement from Happiest Minds as well, where we'll be leveraging Agentic AI platform for helping our customers. But end of the day, if it's, let's say, a Claude or some other agent, it's as good as having a developer. And what companies like Happiest Minds and other IT service companies will have to do is to construct a hybrid model leveraging the coding agents and your physical agents, physical developers working together. At the next level is some of the abilities that
Sorry, Joseph, coming in again. You're saying in a short bit we will see an official announcement with regards to an AI partnership at Happiest Minds?
Happiest Minds, that's right, yeah.
And this is a partnership, right? So we just want to be careful as we put
something
it out.
Similar to Anthropic, but it's a platform, an AI platform that we would be leveraging to deliver services to our customers.
Okay. No, the Infosys bid, right? Are these tie-ups consequential? My question is it formalization of the agreement already, or this would entail, as I asked you, would this be revenue sharing? What would this mean really?
How Infosys has structured it, I'm not sure.
No, because you're also structuring something similar. So I'm just saying, is this an acknowledgement of what's already happening or something else?
I think it's an acknowledgement of what's happening, and I would say that it will be, the path that we would be going down wouldn't be revenue sharing, but I would be, we would be open to that as well if the upside and the opportunity that we get is more. I think all of us have to be very agile and make sure that we make adjustments and to our execution and commercial model, depending on how the technology evolves, partners evolve, and what customers ask for. And that's what we want to do. And if you look at, the tagline that we have, AI first, agility always, that's what reflects it. Because I think AI is the way forward, and you need to be very agile in terms of how you operate, how you construct your commercial model.
Joseph, these would not be exclusive.
Just 1 minute. Joseph, just one thing. You said we would be willing to go down that road in terms of revenue sharing as well. That's what you said?
We would be willing to go down revenue sharing as well as to outcome-based models with our customers if the construct makes sense.
Okay, if the construct makes sense. Got that.
Absolutely.
Got that. And that's an
to be
interesting...
very agile. That's what we are very clear about internally.
The partnership that you're announcing now, today, is outcome-based or revenue sharing?
Not today. We're not announcing today. We're going to announce shortly is what I said.
Shortly.
Yeah.
Got that.
And, yeah.
And these would not be exclusive partnerships with... These would not be exclusive partnerships. Over the course of the year, do you think you will be... Because it's out... Go ahead, yeah.
No, you cannot have exclusive partnerships, Rima, because the technology and the underlying models are evolving and changing so rapidly. I think you need to have flexibility and leeway in how you operate. You can always have preferred partners. I think that is desirable as well, but that should also be based on a little bit of planning and having some visibility into your markets, into your GTM, and into your capabilities.
Okay.
Hi, Joseph. I think my colleagues have gone on a fair bit and understood a fair bit with regard to the AI talk. Another question that shareholders are asking is, what is the promoter entity's intent? I think you saw that coming. The promoter holds a little more than 40% in the company, and various reports suggest that he's looking to sell either full or part of that stake. In your discussions with him, is that a possibility, or do you want to completely rule it out and deny these rumors?
So, that is a question for Ashok to answer. But, whatever discussions we've had internally does not come up. As you know, sometime back, Ashok did divest a little bit of his stake for Happiest Health. But, the AI First initiative that we announced, Ashok reached out in spite of, the new structure that we put in place. He's very excited about the potential of AI and the impact it can have on the company. So Ashok will be leading our AI First initiative, which is a 3 to 5 year strategy that we had put together. We had advertorials and shared a lot in the press conference that we had just last week. And so Ashok's going to lead that initiative. So he's very committed to Happiest Minds and to the growth. And so he'll be driving this initiative. One of the reasons was, I have enough on my plate, the 10 transformations that we had announced. So Ashok felt that if he could help with this initiative, it could really bring various parts of the company together.
Joseph, I got the strategy and, the part that Mr. Ashok wants to play. But his holding has come down, from around 53% to around 44%. Do you think he'll be open to, pulling down stake a little bit more, continue to be involved with the company, but maybe in fact, selling a majority stake?
See, that is a question for Ashok, actually, but in our discussions, that's not something that has come up. And what I'm encouraged by is, the fact that he's willing to take up something like this as a ownership and something that he's committed to the board to drive through for the next 3 to 5 years. And that shows the commitment that he has to the company.
Yeah. Joseph, sorry, just one last question.
Sure.
Apologies on this. You said this revenue sharing versus outcome-based revenue models. You're open to both. Do you think the future across IT services companies is outcome-based models? And if it is outcome-based models, is that not a big shift away from how companies charge customers right now?
So, I would love to have that, but in the past, whenever we've got into outcome-based models, and we've done this 4 or 5 times, I think when the customers, when they start off discussion on outcome-based, they're quite excited. And then it also means that customers have to relinquish control over what happens and, hand over things to their partner. And very often customers are not comfortable. I think in the AI era, where there's a fair bit of productivity and other gains to be made, I think as a IT service company, I would like to shift, or we would like to shift some of our revenues at least into outcome based, so that we can partake of the upside from the productivity enhancements that we get from AI.
I would thought, sorry, I'm reducing everything to a binary, but that's only because of lack of time, and we can have a longer chat. But I thought it's net negative if you move to outcome-based pricing. Am I wrong?
No, I don't think so, because when you get into outcome based, you can price in the productivity enhancements and whatever value you bring to the table into your pricing model. Again, it'll have to be done. You can't do it across the board, but you can do it, where it makes sense for both parties. And I feel it's it's an opportunity to actually partake of the upside that you get from some of the gains that we're getting from AI.
Got it. Thank you very much, Joseph. Appreciate you joining us, and really, a good conversation, and we can probably do more of these as we kind of sort of work our way through all what is happening with everything which is going on around AI. Thank you. We'll take a quick commercial break here. Tenneco management on the other side. It's a recent listing. Stay tuned. Coming up.
Welcome back. As promised, let's get straight to the management of Tenneco Clean Air. It reported actually a healthy set of earnings in the past quarter that was driven by advanced ride technologies. And after the recent trade deals, the management also expects their export growth to accelerate with lower tariffs. To discuss this and more, we're joined by Arvind Chandra, the CEO of Tenneco India. Hi, Arvind. Good morning. Always good to see you win. A quick couple of questions, for the year and now. The recent big headline for the nation on the whole was that we got into a deal with the United States, and we have also signed, an FTA agreement with the EU. How big is it in terms of a potential for you? Exports are still smaller as a percentage of the mix, but how do you view both these two in terms of how you can compete? Please go ahead.
Yeah. First of all, very nice to see you, Nigel. Hi, Rima. Hi, Prashant. Very nice to be here. Very good question to start off with. Our exports have been historically kind of low as a percentage of sales. We've only been 5% of sales exports, historically speaking. Our order book right now is coming in at 20% of the total order book, which is fantastic news. Now, this is before these new announcements. So this new Indo-US trade deal, which reduces tariffs from 50 to even lower than 25, now 18%, is going to make us more and more competitive, right? So India already has the labor cost arbitrage. Again, our factories are cutting edge, state of the art. So along with the labor cost arbitrage, we think that our order book will only grow from an export standpoint, will be more competitive. So we welcome this. I think this is good for us, good for India. Okay. And we're obviously standing on top of the India situation with the auto sector. So we're very, very excited.
Arvind, just to get those numbers correct, as a percentage of revenue, it's around 5%, and a percentage of your order book, it's around 20%.
Recently, the last several months have seen very high order book from an export standpoint. When I say exports, by the way, it's not just Tenneco India exporting to third-party OEMs. It's also Tenneco India exporting back to Tenneco Europe and Tenneco US. Because we have labor cost arbitrage, and also many OEM customers are also demanding that India become the export hub for the company. So we're enjoying the benefits of both.
Yeah, that's what would be my next question, whether or not the Indian listed company can actually be the hub for exporting to markets like the United States as well as the European Union. And you've answered that. So we got that out of the way. Since you mentioned order book, could you quantify what is the current order book? You won a couple of orders, as I see on the exchanges. Quantify it. What is it right now?
So look, we decided that we would publish order book every 6 months, just to kind of be able to collect all these various order book, because there's tens of wins, right? So we will publish our year-end order book after the end of the financial year. So I would ask you to ask me this question in about 2 or 3 months. But suffice to say, in Q2 for the first half of the year, we had 9840 INR million of order book, which is great. And with the current order book, the way things are going, our 2028 revenues have already been order booked to 100% level, which means it gives us a very clear sight of a nice double-digit CAGR revenue growth, which means we will easily outperform the market by somewhere 9 to 10%.
Okay, so Arvind, 100% revenue visibility through FY28, which positions the company for a double-digit revenue growth. Hi, good to see you. What about margins? You've expanded your margins. Your 9-month margins are now closer to 17.5%. What led to that? And can 17-18% be the new normal for margins?
Right. Very good question. So look, Tenneco is a very, very different company. We believe that our culture is our sustaining competitive advantage. And our culture is so strong, right? We talk about the Tenneco mindset, the Tenneco values, our P3 operating system, which is a very unique model where you have, as you and I are talking today, there are people in our factories that are labeled as continuous improvement people. And their only job is to keep looking for ideas to cut costs, right? Across the entire P&L. And I'm talking about raw material conversion cost, fixed costs, customer negotiation, indirect material, you name it. So this culture over the last 3 years, if you remember during the red herring prospectus filing for the IPO, we said that we were able to improve from FY23 to 25 by almost 400 basis points, right? So our EBITDA improved by 400 basis points. And that continues, by the way. So as we're booking nicely, right, our order book is coming up nicely. We've got a nice site, double-digit CAGR growth. There are people in our factories that are constantly looking to attack costs, right? And therefore, we believe that our EBITDAs will not only be sustainable, they will grow. One is because you're getting better absorption from the top line into the bottom line. But the second thing is part of our what we call the P3, the People Pride Performance Operating Model.
Margins expand from here on.
Absolutely. Well, expand in a gradual way. We want to make sure that also, that also, and again, our cash conversion is very good. So as the margin expands, we think that
we have a number, Arvind, say by FY28, which is, because you have a double-digit revenue growth visibility till then. Where can margins head?
Well, we aren't allowed to talk about our future margins, but I think suffice to say, they'll be sustained and they will likely grow in the future because, again, organic, and we haven't talked about inorganic yet, but I think they'll be sustained and they will grow from this point on.
So you have inorganic on your mind as well. Could you give us an insight into what could the potential acquisition look at? Which geography could it be at? Arvind, I think we're allowed to ask you that. You told us order book in the next 6 months. We're going by that. Next interview, we'll ask you about that. But give us a sneak peek into this inorganic growth plan. How large could the target be? Because you'll be looking at quite a few. And which geography? Will it be in India? Will it be overseas?
So we've always said that, when you asked me the question some months ago, why are you doing the IPO, right? So this IPO gives us currency to be able to tap into capital markets or either a primary or even tap into debt market. So I think now that we've had a very successful record IPO 2 months ago, we think now we are ready to explore inorganic options as well. And again, there are different ways of looking at it. It could be something in our domain, in the world of clean air, exhaust systems, ignition, powertrain, as well as suspension systems. So we would be basically taking the technology roadmap and furthering and looking for the evolution, the next evolution of that technology, right? So that was one kind of acquisition. The second one was like a customer pain area type acquisition where the customer themselves come to us and say, you ought to take a look at this company. But basically what we're looking for is niche areas, niche segments that are sort of powertrain agnostic, so that we don't want to be either ICE or EV. We want to be agnostic to any kinds of automotive powertrain, but also we're looking at industrial. So commercial truck, off-highway, industrial, these three are areas that we would be looking at for potential acquisitions. Okay. And again, these acquisitions can also be, one is third party, just outright buying a third party company, but It could also be acquiring assets of our own let's say sister divisions, which are either underperforming, where we can bring it to India and export back to them at a equal or better margin than where we are.
That'll be
the margin has to be accretive. We're not going to accept anything that will dilute their margin.
Oh, that's good. Good to hear that finishing sentence because, Indian listed company buying from the parent sometimes is a little bit tricky. But as you're saying, it should be margin, it should mean that it makes sense for the Indian listed entity. So I'll take that point on board. Arvind, two big takeaways for me. The visibility is there till FY28, and that's why you're going with good growth. And India could potentially be the export hub as well. Thanks a lot, Arvind, for joining in. From your IPO price, the stock is up close to 40%. So additional responsibility on you guys delivering those numbers. Let's get in Chandan Taparia, though, who joins us on the show. Hi, Chandan. If you bought the morning dip, you would be happy. Markets almost moved into the green. What's your view in terms of levels we're looking at on the Nifty? And fill us in with your picks.
Yeah, good morning, Nigel. Thanks for having me. Yes, we are suggesting to buy the morning dip. In fact, we have the view that market has formed the short-term bottom near to 25,350 to 25,400. If I look at the daily and the weekly chart, multiple times this level has respected and has provided the cushion to the market. So I believe that 25,400 could act as a major support. And with this support, index has potential to see the momentum towards 25,850 to 26,000. Talking about Bank Nifty index, we have seen a massive run-up on the last trading session. Higher base is clearly visible. Till it holds about 60,250. Bank Nifty has potential to head towards its all-time high of 61,500 to 61,750 kind of level. So buy on decline in both the indices with the view that consolidation seems to be getting over and fresh leg of rally can be seen in indices from here onwards.
Stocks, Chandan?
Yeah, so talking about the stock specific idea, first that is buy on Lupin, one of the counter which has been consolidating and now has given a consolidation breakout on the daily and the weekly chart. We have seen put writing activity and data setup is quite positive as consolidation breakout of 28-29 days is visible with decisive hold about 2200, 2240. So one can buy with support of 2220 for an upside target towards 2350 level. Second trading idea, that is buy on Union Bank. We have positive view on most of the PSU bank. However, SBI is our preferred one, which already rallied well. But now for a fresh breakout, recommending to buy on Union Bank. We have seen built up of long position. Sustained put writing is visible. Stock is given a consolidation breakout of last 23 days. So recommending to buy with support of 176. And this PSU counter can head towards 195 kind of level.
Okay, all right. Chandan, good calls and good speaking with you. Talk to you again soon. By the way, you know, the reason why the markets picked up pace from the lows, of course, is IT, right? I mean, I just looked at the Nifty 50 pack. Infosys is adding 32 index points to the Nifty right now. ITC is number 2 with about 17. And then there's a TCS and HCL Tech, which are between them adding another 13 points. So about 45 odd points on the index recovery has come from three IT names this morning. So the index itself is up about 2.25% at this stage. The Nifty flat 20 odd points lower. We'll take a break. Manisha on the other side, commodities in focus. Stay tuned.
Welcome back. Let's talk commodities now. Manisha is now joining in for more on that. Manisha, what are you looking at today?
Well, I'm looking at EV as a market because we're looking at very strong numbers. The reports for 2025 has started to trickle in finally. And when you look at the overall EV battery metal index, that has surged to a 27-month highs. Everything that comprises of metals that are used in EV, the prices of that, after strong gains in 2025, have continued to gain in 2026 as well. So when you look at the raw material bill, well, that has been surging as well. Only for the month of December, it stood at a tall $2 billion for the first time, that is since 2023. And when you look at the overall 2025 as a market, that is up 13% on a year-on-year basis, gaining almost up to $15.8 billion there. Now, these are the various metals which are used in EV and the raw material itself, and the prices of these have continued to gain up. Lithium, for one, has been an outperformer, up 21% in this year so far. 4 to 5% of gains is what we're looking at in other metals like cobalt and magnesium as well. Nickel prices have gained up by 3% in the meanwhile. If you look at the overall EV global passenger market in 2025, well, that is estimated up by 20% versus 2024 therein. The global passenger EV market is likely to exceed 30 million units in 2025. And within this market, when you look at electric car market, that is expanded by 25% in the previous year. So very strong numbers coming in for this one. Let me remind you that China is a very strong market, on almost 80% of those numbers coming in from China, 12% from Europe, and the rest, of course, in the US, etc. The battery capacity deployment also has been on the stronger side. This is a report from Adamas Employment. Their estimates, they believe that 286 gigawatt is what we were looking at in 2021. 1 trillion is what we've crossed when it comes to 2025 therein. Take a look at the copper prices. That also is a strong EV component and a green energy revolution metal as well. And while we've seen prices decline 1% overnight, it also is down 15% from its record high in the month of January, when we saw 14,500 on LME and $6.5 on COMEX therein. The copper prices and the global exchanges also have continued to see a bit of a decline. But the important number to watch here is that the global exchanges, the stocks therein, is now 1 trillion tons, and this is the highest that we have seen in the last, pardon me, in 21 years. So the combined stock on US, in LME and Shanghai has continued to surge quite strongly there. In the meanwhile, the other market, pardon me, the other thing that you have to watch is the January copper smelting numbers. Those are the lowest in a decade. So what the street is looking at is that the new metal is not coming into the markets, and on the exchanges, warehouses, there is metal lying, which is the highest in last 10 or 15 years. So that is what is keeping the copper prices in the meanwhile in check.
Okay, all right, Manisha, thank you very much for that. That's Commodities in Focus. Time for a quick commercial break here. Well, the much-awaited chat on tariffs and exports with the Vice Chairman of Gokaldas Exports, G. Sivaramakrishnan. Latha will take that conversation forward, coming up in just a bit.